Hong Kong's monetary authority intervenes again to stop the Hong Kong dollar falling off its peg to the US dollar. ANZ sees the Reserve Bank of India cutting today, and Australian consumer confidence hits a 3-year high. That's coming up in our 5 Things in 5 Minutes on Wednesday, August the 6th. And in our deep dive interview, ANZ senior economist Miles Workman looks at the implications of significant job hoarding in recent years in New Zealand.
There is a risk that if the recovery doesn't evolve as firms have been expecting, they may decide or choose, or they may be forced to shed some of this hoarded labour just because the demand's not there.
But first, in 5 and 5 with ANZ, the Hong Kong Monetary Authority intervened yesterday for the third time this week to prop up the Hong Kong dollar on its peg to the US dollar of 7.85. ANZ China economist Vicky Xiaozhou says there's 2 reasons, starting with the wide gap between low Hong Kong interest rates and high US rates, and that's the driver for carry traders.
First is the wide yield gap between US and then Hong Kong. So people seeing the opportunity that borrowing Hong Kong and invest in the US dollar dominated market. And the second reason we've seen so far is the 1,000 bond money withdrawal. So money is flowing outside of the Hong Kong equity market. So that's pushed the Hong Kong dollar weakness.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 was down 0.5%, the Nasdaq down about the same. The US 10-year Treasury yield fell another basis point to 4.19% overnight. Gold rose 0.2% to $3,434 an ounce, while West Texas oil futures fell a further 1.6% to $65.24 a barrel. The US dollar index was flat, as was the Aussie dollar, at 64.69 US cents. And the Kiwi was down 0.3% to 58.93 US cents. Number 2. ANZ Research is forecasting the Reserve Bank of India will cut interest rates later today. Here's ANZ India economist Diraj Nim.
We're taking an off-consensus call for the Reserve Bank of India's decision today. We expect a 25 basis point rate cut to the repo rate, and we've brought it forward from the October meeting to the August meeting on the back of our assessment of the growth inflation mix for the economy. The consensus is that the Reserve Bank of India will hold the repo rate unchanged today, although it will maintain its neutral stance, but there is a general view that it possibly has space to move once more, perhaps in October. We think it can happen and should happen in August itself.
Number 3. Diraj says it's all about inflation being very low at the moment.
So 4 quarter hence, inflation is looking above 4%, but till then, for the next 6 to 9 months, it's going to be extremely benign, creating what I can say is a safe space for monetary policy to be a little more dovish to support growth. And why do we need to support growth? Well, if you look at most high-frequency indicators of activity, be it bank credit, passenger vehicle sales, exports, industrial output, core sector output, all of them have decelerated into Q2, implying that growth slowdown may not be over yet.
Number 4. The ANZ Roy Morgan Consumer Confidence Survey for Australia found a rise through the 90 mark for the first time in 3 years. Here's ANZ economist Sophia Engala.
So what largely drove the rise in the headline number last week was increased household confidence in their future finances. And that came after last week's Q2 inflation data showed that underlying inflation did ease in the quarter, and the result raised the likelihood of an RBI rate cut at its August meeting. So that discussion there of a prospective rate cut could have contributed to that improvement in financial confidence there.
Number 5. Indonesia reported stronger than expected GDP growth in the June quarter of 5.12% from a year ago. That was up from 4.87% in the March quarter. Here's ANZ Asia economist Crystal Tan.
This rebound is encouraging as it points to renewed momentum in infrastructure development following a period of elevated policy uncertainty during the leadership transition. However, looking ahead, this pace of growth seen in Q2 may be difficult to sustain. External headwinds, including higher US tariffs and softer global demand, are likely to weigh on the outlook. Now, private consumption is expected to remain steady, but it will likely be constrained by ongoing labor market fragilities. Now, against this backdrop, we continue to see room for monetary policy easing, and we have penciled in 2 more 25 basis point rate cuts in the current cycle.
Crystal Tan there. Now, in our deep dive interview, ANZ New Zealand senior economist Miles Workman teases out the implications of significant job hoarding in recent years.
Essentially, when we've looked at the data and played with a few models to try and work out how much firms have been holding on to labour in anticipation of an economic recovery, we've found that the unemployment rate has been suppressed perhaps to the tune of 0.5% or so. So, for example, when the Q1 labour market data came out and it read with an unemployment rate at 5.1%, we estimate that if firms had not been hoarding or holding on to labour, the unemployment rate may have been closer to 5.6%. So then the natural question then becomes, well, what happens if the economic recovery that firms have been expecting, the whole reason they're holding on to labour is because they anticipate demand and the economic recovery to kick in and they can then utilise that labour. So the question becomes, well, what happens if that doesn't happen and firms have to start thinking about their costs, and part of those costs could be a hoarding or a shedding of some of that hoarded labour.
So what makes you think that they're going to change their minds, if you like, and decide that it's time to give up?
There is a risk that if the recovery doesn't evolve as firms have been expecting, they may decide or choose, or they may be forced to, that's probably a better word, shed some of this hoarded labour just because the demand's not there for these firms to be able to make a profit and hold on to labour input that they're just not utilising. So the big risk here is the economic recovery that we and the Reserve Bank and businesses more broadly have been expecting. If that does start to sputter a bit and it doesn't eventuate as expected, firms just may find it a little bit difficult to carry on with the same amount of labour that they're currently holding on to, and therefore that could result in a shedding of that hoarded labour, but ultimately a looser labour market overall. For the Reserve Bank, that would imply a wider for longer negative output gap and less labour cost inflation and therefore less non-tradable inflation, and that would therefore increase the odds that they would see an undershoot in their inflation target. So therefore you'd expect the response to that scenario to be the Reserve Bank cutting the OCR more than they've been recently signalling, and perhaps even more than the 2.5% terminal that we've penciled in.
Yeah. Could you give us a sense of whether you're seeing any signs of this yet? How will we know that this is happening?
So if we saw the unemployment rates, for example, this week, we're expecting 5.3%, which includes a labour hoarding factor, I suppose you could say, recent trends continuing in the labour market. We would be surprised, or we would probably be more likely to conclude that there's a bit of shedding going on if we see an unemployment rate come in anywhere north of about 5.5%, given typical volatility in the HLFS survey. So that's really where the proof in the pudding is going to be, with a higher unemployment rate than we are currently forecasting over the back half of this year. So to be clear, we are not forecasting a scenario where firms start shedding labour, but we are identifying this as a very key risk. And what makes this part of the business cycle quite different to recent history is that the past supports, government subsidies, for example, when the economy's gone through lockdowns, they were very strong following shortly after the pandemic, but they're just not there now. And there is a bit of evidence that firms' balance sheets just don't have as much capacity to keep holding on to hoarded labour as much as they did, say, even a year ago. So what that all really does mean is that if the economic recovery, if demand doesn't pick up, then the firms may need to be maybe faced with much tougher choices around whether they should keep holding on to some of this labour.
Miles Workman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, August the 6th. Catch you tomorrow with analysis of New Zealand's jobs figures due later today and the Reserve Bank of India's decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.